Hello and welcome to the Kiwi Advisor Network podcast. I'm the host, Warwick Slow, and today's guest is Kris Ballantyne from Partners Life. Kris is extremely experienced. He's been part of the furniture at Partners Life since its inception. He's been an advisor himself, and he's been a big part of Partners Life growth. This podcast, we've got a lot of tips on, if you're an insurance advisor already, just some ways of potentially tackling those inflationary questions and premiums rising. And if you're not doing insurance advice already, or you're considering referring it or making it part of your business, this is also a great resource, and it will count towards your CPD points. So make sure you log it in your register. And remember, you can also listen to this podcast on Apple or Spotify. If you are watching this on YouTube, there's different ways to consume it. Otherwise, let's get into it. Kris Ballantyne, welcome to the Kiwi Advisor Network podcast.
Thanks, Warwick. Good to be here.
Stoked to have you here. You've been in the insurance industry a very long time for such a young man. How'd you get into it?
Yeah, well, it's kind of in the blood, you might say, familiar links, as is the case for many people when they get into an industry like insurance, which is probably not the logical choice for anyone coming out of high school or university. It's not, I think, anyone's dream to get into life insurance in the same way it's not anyone's dream to probably get into, advisory services. So my mother, Naomi Ballantyne, I'm very proud of that fact, but she has, to our knowledge, the first woman in the world to found a life insurance company, which she did not once but twice. An original employee of Sovereign, a founding employee, founded what is now Chubb Life in New Zealand, at the time Club Life, sold to ING and ANZ in a joint venture, and then finally Partners Life. So I grew up around insurance, life insurance, and I guess, going in out of school holidays and whatnot as a, I won't say a child, but as a young man, a teenager, coming in to help issue policies, do some underwriting administration, paper management, file management, etc. You get a feel for what the industry's like, and you build a surprisingly versatile skill set in that time. And so when I left school, started in university, I don't want to be in insurance. That's not what I want to do. I want to do computer science. Started studying, but needed some money, obviously, despite my parents, not being poor by any stretch. There was no free ride from them. It's a, important part of that. Took on a part-time job in ING Life at the time on the night shift team. So, university during the day, prop loading and policy issuing at night, and quite enjoyed it, to be honest. But the kind of big inflection point was, around the same time I was getting a bit bored of computer science and going, I like the technology behind it. I enjoy tech, but I don't see myself being a programmer. I am too personable for that. I like contact. I like sort of, exploring a little bit outside the box, rather. I got offered a full-time job there, took it, haven't looked back. 17 years later, here I am, still in the same industry.
I did an interview with Andy Turner, who's an insurance advisor. And
I know Andy very well.
So I think he might have done data entry at ING as well.
He did, actually. His older brother and I worked together when I was 16 and his brother was, 20 odd? So Andy's a little younger than me, but yeah, we've known each other for a surprisingly long time. He was a kid when I met him, effectively.
Because I think he had a similar message. It was like nobody plans to get into it, but then you think about most high school jobs that people do.
Yeah.
You're working at the supermarket,
That's right.
fast food joints, but the skills you've learned there have taken you on a completely different path to what you might have gone.
Absolutely, and it was beneficial as well. I think a lot of people, when they enter insurance for the first time, coming from a specialized role, so sales is a particularly interesting one. A lot of, you guys will know, in kind of the more holistic advice industry as well, a lot of people get into advice not having had a background in a provider or a bank, as it were. And that's good, because bringing that sales skill, that charisma, the ability to connect with people is really important. But what I think was really beneficial was building a solid foundation and understanding the mechanics behind what's occurring in insurance at every step, the operational processes, the core systems that these things sit on, how the premiums work, how the quote engines work, and this is dating back mid-2000s when things weren't quite as technologically advanced and not paper and, pen, but the tech was a little more primitive. And so you've got a really good look behind the covers that, sets you up really well for the future. And so, I'm very lucky to have had that opportunity, and I'm very grateful for it, but also like to think I've made the most of it over the following close to 2 decades since then.
the understanding of the background systems is something you just can't discount.
Yeah.
And I know Andy, he leans on it heavily as
Yes.
part of how he operates. And
Yes.
I mean, how can we get more people coming through? Do you do like a graduate program where you
Yeah.
get youngsters into the business?
We have done from time to time. So, a few things about myself. I look after a number of different teams in Partners Life, one of which is marketing, which is probably alongside, I would say, finance, interesting accountant and whatnot, the least industry-specific skill set, right? A good marketer is a good marketer. Someone that understands communication is more valuable than someone necessarily who has a good insurance background. You can teach one. It's harder to teach the other inside the business. In that team, we've done a couple of rounds of sort of like, what would you call them? Not graduate programs. I can't even think, internships. We always feel bad about them because the universities, particularly Massey, mandate that they can't be paid internships, but we always find a way to provide some nice things for those interns when they come through.
Some health insurance cover or something.
Well, maybe some preloaded credit cards under the table or, a bunch of merchandise, whatever it happens to be. Yeah, those sorts of things, exactly. But we also are really proud of something we've had since the start, which is, we call it the admin team. It's kind of equivalent to where I started. It was a night shift team back when I started. These days it's day shift because we're not so, back then systems were hosted on a PC, which meant only X number of users could be accessing them at the time. And so you had that many PCs in your office. These days it's all cloud-based, so we don't really care how many people or how few people necessarily from a systems point of view. So we've got quite a large team that started, back in 2011 as sort of casual workers, but we pretty quickly moved that onto a permanent role type basis. And that is intended specifically for people who have no industry experience, like, in fact, no financial services industry experience. Just to kind of understand how we get people into there, Partners Life since the start has been, I would call it a family company. And it's not a family company in that it's, my family or whoever's family that is the business. It's that one of the philosophies we took on when hiring people early on and have kind of kept to is that you can teach people skills. You can build experience. You can teach them how to use systems, understand processes, understand concepts, but you can't teach someone to be a good cultural fit. And so because we were a startup with relatively limited capital in a really big market, right? Insurance is big players, big money behind them. We needed to be better. We needed to have a better quality of person, a more adaptable culture, sort of quick to make decisions all the way through the business. And so we kind of make a decision early on that a vouch from someone who's already a known quantity is more valuable than a CV with a lot of experience on it. That's not always family. It often turned out to be. And so, we've got a whole heap of employees who have wives, children, brothers, friends working within the business. And that's, I think, been a massive boon. Funnily enough, there was a whole community of people from Scottish Pipe Band because a couple of their employees made it in, I guess, the traditional way, and then they've kind of continued vouching. And so there's a really clear pathway through admin team, which is not just basic data entry. It goes all the way through all the core operational processes, all the stuff that happens, when something's received. There's a policy needs to be loaded, needs to be set up correctly, all that stuff, the actual process-based stuff. And so, over the years, we actually now have a few general managers that started in the admin team at this point now, X years on from those days. But it's a really strong talent pathway, and every team in the business will have success stories that came all the way up from no experience to quite senior and specialized roles. And so it's something I'm personally really proud of, having been a very young man when I started in this industry, which at the time was still skewing quite old relative to other industries, that we've been able to provide so much opportunity for fresh thinking, fresh people into the industry. And, that's been rewarded largely. You're always going to have some failure stories, but by and large, it's been really successful. And hopefully it's something that we can kind of continue into the future. We're a bigger company. We've got some more considerations around things like needing a formal recruitment, manager process, external consultants for some types of roles. That's the nature of our parent company, Doozy Life, is listed. And so there's a few more controls than when you're a privately held company. But I don't think that's going to affect us too much, right? In the scheme of their business, we're the smallest business unit.
It's funny how you talk about people working the way from like almost the bottom to the top into managerial positions. It's like the US Postal Service. To get to the very top, to manage the US Postal Service, you have to have started at the very bottom and been delivery mail up until you get to that top slot. I know a lot of advisors will also run, generational family businesses. What is it like working with your family, and what advice would you have to people who are considering it?
Yeah, I mean, I've found it good. By and large, I've got a number of family members, not direct family. We're a small family. I'm the only child. So that frees up that problem of potentially working with your siblings, which I think when you're younger can be challenging.
And older.
But, I've got uncles, cousins, second cousins, etc., that work in the Partners Life business. And actually, prior to Partners Life, we'd had a advice startup, which was mostly a close-knit group of friends and family kind of getting together to start that business. I found it good. It's just all around, I guess, being able to separate work and personal life from a point of view of there are times when you're going to disagree and work, and it can be a violent disagreement, not violent in terms of you getting your fists out and getting pugilistic, but more in terms of if you are passionate about the business you're in, you're going to have strong opinions of it. And when strong opinions clash, it can get heated. But being able to put that to a side and kind of move past it when 5 o'clock rings and you're out in the car park. I work with my wife. We actually work quite closely together, and that could be really bad. It is for some people. It would be impossible for some people. But, with all of the family that I've worked with over that time, you just have to understand and communicate the clear boundaries around this has got nothing to do with your ability to form cohesive opinions or your intelligence or what I think of, you. It's about this piece of work in this moment. And as soon as we're not talking about that, it's a different story. If you can't do that, don't do it, because, you can really compromise those relationships. But for me personally, it's been great. In fact, probably the only challenge has been specifically with Naomi, who has been our, managing director the entire time at Partners Life, in that we have clear boundaries, but to the point where we're so willing to have fiery debates, in the middle of an executive committee or a board meeting, to where people think we don't like each other at times. Where, people who are not familiar with that process, new people come in and often go, "Are you guys all right? Like, what was that?" And it's like, no, it's just this claim or this policy wording feature. We both felt really strongly about in opposite directions, and that's been healthy for us, because the problem with a founder-led business that could be perceived to be Partners Life, right, where you've got a really quite well-known founder in an industry, a bunch of accolades, a high amount of respect, is that it can be problematic for people to feel like they can challenge some things, in those environments. We have had no challenge with that.
And have you ever accidentally called her mum in an important meeting?
No, I never have. I've always called her MD for managing director. It's just easier that way. But a funny story, when I was 16, working on the night shift team, I had long hair. I do now as well, but I didn't for a long period of time. I've just brought it back in my, getting near mid-30s, maybe, what do you call it, like a third life crisis, potentially. I had long hair, blonde hair, relatively skinny, sitting at the desk with her headphones on. You'd think it'd be quite obvious who I was, right? So she finished her work at 5:30, came downstairs to where the night shift was just starting, and was looking for me. And unfortunately for her, there was another guy called Patrick, who was the same height as me, had long blonde hair, fairly similar build, and was sitting at a table right next to the elevator. So she walked right up to him, grabbed him, gave him a hug and a kiss on the cheek and said, "Hello, honey," until he turned around and just about bloody passed out. And so, because there's the big boss for a 18-year-old guy who's just started in this finance company, didn't really know what it was. It was must have been mortifying for both of them. I found it hilarious.
Yeah,
I still live on that story, 17 years later or whatever it is.
Accidental hug and a kiss.
Yeah, it was great. It was fantastic.
And how did you find things change with the acquisition that Daiichi?
Yeah, it's a good question. Well, it's relatively recent. It occurred right at the end of last year in terms of the completion of that. I'm not going to sit here and lie and say I didn't know about that before. Obviously, there's a long process with any sort of large M&A that goes into it. But the advantage of that transaction for us is that, right when we started Partners Life, we had a vision to get to a sale point. Of course you do. People put in founding capital. And along the way, they have to exit. They can't hold their capital forever, and it needs to go to a more corporatized model. And so we took on some capital from Blackstone out of the US quite early on. Now, Blackstone are a private equity firm. They come with some strings attached, some conditions, as any venture capital type firm do. But that was great for us. However, at that time, kind of as a wider leadership founding group, including shareholders, some senior staff members and whatnot, it's kind of a brainstorming session about what do we want the next kind of liquidity event to be. Because it could be an IPO, although New Zealand markets are quite weak for insurance companies. It's not a sexy kind of investment from a retail point of view. But if this markets were strong enough, maybe that's good. But we also wrote down a list of kind of top candidates for a trade sale. And what we had always wanted was someone that was a life insurance specialist, because unlike many others, we've not branched outside of our core business. We've intentionally stuck to being the best life insurer, life and health insurer, because adding too many strings to your bow and all of a sudden it's no longer a bow, right? You can't fire an arrow. So we stuck to that, and we wanted someone else who believed in that vision as well to be our owner. You need to understand life insurance to own a life insurance company. So interestingly, when we did that back in, 2014, I think, Daiichi Life were the number one on that list. There was a couple of other Japanese companies and then a few from Europe, but there aren't that many big life insurance only companies in the world. Daiichi is one of the biggest and the most well respected. And so when we actually heard they were interested, a couple of years ago, it was like, wow, this is fortuitous. And so we were really happy with that. And our expectation was, as a life insurance specialist, buying a life insurance specialist in New Zealand when they already owned a life insurance specialist in Australia who we knew quite well, Intel, that it wouldn't be too much change. And that's largely been proven true from a day-to-day point of view. There's no difference. We've got a few guys from head office who've come and joined our team, but they're there to help, for example, our finance team translate business plans into the format that head office aggregates them in, and, help us implement the new accountancy standard that's, going to be required worldwide. But nothing's changed from running the business. I guess the only challenge is rectifying. We're a very capital-intensive business. We spend a lot on things like innovation and technology. It's always been one of our unique selling points. We're already very far ahead in terms of a number of those areas than any of the other units, business units amongst the Daiichi Group. And so trying to justify, well, we need to go even further and, drive ourselves even further can be challenging when you're talking to people who don't even have some of the stuff you had 11 years ago when you started, like cloud-based systems, for example. And so it's not a problem, but I guess just it's a learning curve for us in this first year. How do we communicate these things in such a way that you don't end up with any sort of like confusion or maybe it's not resentment, but kind of like, I guess, resistance against what you're asking for, on the basis that you have to remember you're now one of 11 companies around the world and not just one of one.
And how has the inflationary environment affected Partners Life?
Yeah, I mean, it's really interesting because inflation in and of itself is bad for insurance. Obviously, premiums have to inflate in line with, the inflationary pressures on the sum insured. You want to keep the value of the cover someone's got at the same, not dollar value, but purchasing value. And so covers inflate year on year based on CPI. And when inflation's high, the cover amount goes up by more, which then combined with your normal stuff, like as a client gets older, their premium rates increase, mean that you start to see bigger and bigger premium increases year on year, which puts pressures on clients and causes higher lapses, which is certainly what the industry is seeing. It's the highest lapses since about 2008 at the moment across the New Zealand industry. The thing that usually goes hand in hand, though, is this sounds really weird, but financial crises are really good for insurance companies, usually. So the GFC initially had a big problem. There was a big spike in lapses as people initially lost jobs, lost homes, etc. And this affect's seen globally. But as it starts to stabilize a little bit, not recover, but stabilize from the initial shock, money is forefront of people's minds. And so they tend to think more about the adult things that are easy to ignore when, the economy is good. Instead of buying houses and, jet skis, they're going, I really need to sort out my insurance and my retirement protection. And so, 2009 was one of the best years in the history of the New Zealand life insurance market. We're not seeing that now, at least from my perspective. And I guess that's partially because, call it stagflation, whatever you want. We haven't seen the big economic fall that might normally accompany such a, extended period of increasing inflation. Too early to tell, really, but definitely puts pressure on, I guess, clients' wallets. I guess, it raises the question around, is the cost of living affecting insurance as well, or how that's affecting? Because I know it's affecting, all sorts of different industries. And it definitely is, but New Zealand's being more adversely affected than other markets that I'm aware of. And I don't really want to postulate why, other than to know that from my experience as a life insurance advisor previously, prior to Partners Life, overseas markets, Australia, the UK, South Africa, parts of Western Europe, the generally accepted average for spend of household income on insurance can vary between sort of 6 and 10% of household income is spent on some form of insurance. What we've definitely seen in New Zealand, from my experience, is people's threshold is only about 3% that they're willing to spend. So right off the bat, it becomes a value proposition. How much value do people place on the insurance that they may or may not have purchased in their mind? And at what threshold, when it crosses, does it become the easiest thing to drop? And so our tolerance is low, which means we are going to see, periods of inflation, periods of premium increase having a more drastic effect than potentially we would if the same situation occurred in Australia.
It is a grudge purchase for people. And
yes, well, it is everywhere. I would say that New Zealand has some, maybe not unique, but a combination of cultural traits that makes it particularly problematic as well.
Yeah. Everyone's quite frugal in New Zealand as well. But, everybody's feeling the pinch in terms of budgeting. What advice would you have for advisors who are having those difficult conversations with their clients?
Yeah, well, it's a well-known path to tread because affordability conversations for advisors when it comes to life insurance, it's a tale as old as time. The moment a person goes through their first renewal, that's generally the first conversation an advisor is going to have about affordability with that client or, with a client. So you come across it pretty early in your career as a life insurance advisor. Compared to when I started in the industry, the options available to advisors, to clients in terms of retaining cover while reducing premiums are light years beyond. So, for example, with Partners Life, I'll use an example of trauma cover or critical illness cover. So, for those who are not familiar with the industry, that's you're diagnosed with some form of serious condition, whether it be a cancer, whether it be a heart attack, stroke, an intensive care, a period of intensive care, you get paid a lump sum of money. Where that product started was, they called it dread disease or near death. So for a long time it was, you have end stage cancer, you get some money, that's all it is. And so there wasn't a lot you could do with that, right? You either do or you don't. But as diagnostic medicines progressed over the years, as we've got better at early detection, as treatment modalities got a lot better, those products spiral to where in the late 2000s, early 2010s, they were so fully featured that the pricing was getting out of control for regular people. And there is still a lot of product in the market that looks like that. It's available because advisors use it, but they often use it for different things these days. But I digress, that was the only thing for a long time if you wanted to cover that type of risk. But, right now with Partners Life, we have 3 tiers of that product. And they're not tiers in terms of, the breadth of cover. They're tiers in terms of the severity of which the critical condition would trigger a full payment. And they're not mutually exclusive. So we have options to where you can tailor the amount of cover, not sacrifice the cover level, i.e. if you're covering a mortgage or covering, a commitments of debt, whatever it happens to be, you don't have to sacrifice the level. You just have to, tailor at what level of severity of condition would this actually require that payment, instead of it being at the earliest possible opportunity, which is technically best for the client, although I would argue from an indemnification point of view, not that justifiable, to, okay, well, it's going to take something really serious to get this person off work. And the pricing delta between those tiers is quite significant. So, what I'll call the deluxe trauma, the full trauma cover, is about 3.5 times more expensive than severe trauma, which is, that's your kind of critical severe illness. But the breadth of the coverage is the same. The number of conditions covered are the same. The types of conditions covered the same. They're just at a stage where the impact is much more severe. And so all of that to say, I'm not trying to plug our product here. Everyone in the industry has options that didn't exist previously, whether they be, removing, there's opt-out features now for things that used to be always included in covers that have problematic, pricing implications, things like specific injury benefits on disability or income covers that were baked in because they look great from a rating house perspective, and they are valuable, but have quite a significant costing impact. A lot of those have been made opt-out. So you can fine-tune policies really well these days. The only thing I would say is always some cover's better than no cover. In talking to clients, and the temptation for clients will always be, let's just cancel this and go to a cheaper company. Maybe I can get a better deal elsewhere. There's risk in that in life insurance when it comes to the health underwriting. And, if you're clean skin, you've had no conditions wrong in your life, that's probably okay. But the moment you've had any sort of ongoing kind of injury, illness, problem, that becomes really dicey over time to keep moving. The risk of non-disclosure increases, and the risk of going from cover that might be slightly more expensive to cover that's now not going to do anything for you because you've non-disclosed is quite high, and it's quite common. So some cover is better than no cover, and I always feel like it's a matter of prioritizing in an advice kind of setting. You've got needs that a client needs to meet, and ideally you'd like to meet all of them, but you've got to make a value call when you're dealing with that client's finances on where the most important part of that is. And so for a working person, often the biggest risk to them is their ongoing income, right? Like, yes, there's an element of debt. Yes, there's an element of, I'd like lump sums to do X, Y, Z, modify my house, whatever it happens to be. Those things are clients' needs and wants. They're important, but, they can't fund any of their lifestyle without an ongoing source of income. And so is it going, okay, for this client, this risk is number one, and noting that on your advice, if not your advice documentation in the front end, certainly your kind of logic and documentation in the back end. So if that conversation does come up, we're going, okay, well, we're cutting down to bare minimum. This is all we're keeping because it's the most important thing for you. Something that a lot of advisors will be doing, I guess, intuitively or of their own accord, but may not necessarily be actively thinking about and documenting. And realistically, your options are not, keep everything, or, that's not going to happen when a client's really upset and wants to talk about affordability and change things. So you've got to compromise somewhere. It's about, how do I maneuver this client into the position where at least I'm keeping the most important component intact?
Because how do we increase consumer confidence in insurance? It's one of those things that, with the regulation, that was like part of the reason they wanted to bring it in to increase that confidence. Like, what are some other things that we can be doing?
It's really fascinating. There is a perception that people don't trust insurers and they don't trust advisors. Some of that is true. We do a lot of market research. For the purpose of communication, we do some above the line branding and whatnot to try and build some interest in category, not necessarily in direct interest in Partners Life. But, that market research bears out that there is more trust in advisors by quite some margin than insurance companies. And so advisors already are seen as a trusted source of information. The issue comes when it is just perception of the category in general. Like, not do I need life insurance? A high percentage of responders will say, yeah, I probably should have some, but would you ever consider buying it? That's quite a hard no. And so trust is one factor, but I'm not necessarily sure it's the biggest factor. I personally think financial literacy is a really big problem in New Zealand because, like saying life insurance in general, right? It's an indemnification product for a future financial risk. You're having to project your future lifestyle and understand, kind of goals, needs and wants, milestones along the way, make some sort of net present value of a future kind of lifestyle assumptions, and then indemnify against that possible future for today's state in case you get hit by a bus as soon as you walk out of the office. And so it's quite complex. It's a really complex field of advice. There is no hope of being able to understand that component and, what's gone into building out that profile of risk and the indemnification package if you don't understand today's state of finances and, your ins and outflows and, the concept of financial risk and the concept of retirement protection, the concept of like indexation or interest. And New Zealanders are some of the worst when it comes to financial literacy. My feeling is trust wouldn't improve, but if we had, high school level, properly good financial literacy and, I guess not life skills. I know that's maybe a Mike Hosking term, but, teaching people how to understand how to read a paycheck, even back when I was in school, we learned how to read a balance sheet. Now, that wasn't very useful because Xero came out shortly afterwards and made it somewhat irrelevant. But you know what I mean when I'm saying that, right? The basic concepts of money and how they work and the basic tenets of how to interact with the financial market. So, how to open bank accounts, how to understand interest rates, how compound interest works, what a savings account is, what is a credit card, and what am I looking at when I'm, using a credit card? Because, in that kind of retail banking space, there are a lot of people who are using credit cards with high interest that don't really understand what they're doing with it. And so for me, it's not going to solve trust, but if you can build up to a basic level of financial literacy to where advisors who are currently trusted, or at least certainly more than insurance companies, can actually start on the front foot in those conversations and not be trying to pull teeth before you even get to any of the part that's actually where they're adding value, it would help a lot with that inertia of getting people over that initial line, I think, anyway.
Yeah, addressing the root cause. The last podcast we did was with Nathan McLarney, who's a mortgage advisor based in Christchurch, and he's doing something where he goes to schools and teaches kids, well, like his team are going in and teaching kids about financial literacy, why it's bad to get those short-term loans. And it's amazing. Like, you almost feel that not that we should rely on the government for everything, but you feel like there should be something that's included as part of the curriculum.
Yeah, it's been discussed a couple of times. We're in a similar space, very passionate about this issue. And so our major sponsorship for our entire company is with a fintech based out of Christchurch called Banker, who they run it's a tech platform, but it's intended as a curriculum supplement in secondary schools. They've got a primary school variant as well. We support the secondary school, so high school version, which is a simulated economy. And so I think it's about 400,000 students in New Zealand have been through the Banker platform to date.
Is it Banker, but without the E?
It's Banker with a Q instead of a K.
Oh, I was going to say, like any tech company that just...
Yeah, they do something like that. That's right. But they're a financial literacy company. They just built a tech platform to enable them. And it's really cool. Kids go in, a teacher runs the curriculum, but effectively there's lessons within the system itself, and then it's free roam for kids. You can select an occupation. You can control your simulated bank account. You make your decisions around retirement protection. You're able to invest on the stock market with kind of simulated returns over time and an impact on your finance. And we partnered with them to build a module around risk. So, for example, now when that lesson gets introduced and the teacher talks to the students around, the tenets of risk, all of a sudden, they've invested in the stock market. They've attended their quote unquote job for the day by clicking the correct buttons and answering the quiz. They're getting a notification, you fell over and bruised your butt. You're going to be off work for 2 weeks. This is the financial impact. If you had insurance, you would have had a claim. And so you can buy simulated insurance, medical insurance, and income insurance to kind of not do anything because there's no consequence from the decisions they make, although there are leaderboards, but get people comfortable, or kids that are sort of 13 to 15 comfortable with some of the basic ideas, and anything they retain from there, it's not going to be 100% by the time they're 17, 18 at university and starting to have to do these things. But if you can absorb some of it and start you at a slightly higher level, what's clearly shown is that knowledge will become generational. The story of that business is really interesting, which is Kendall, who's the founder and former Young New Zealander of the Year, which I've never sniffed, so I'm a little jealous of her for that. But her family wasn't that well off. Well, I won't say not well off, but wasn't particularly open about talking to money. They never talked about risk. They didn't have insurance. Like, it was quite a typical kind of Kiwi closed off. We don't talk about these things sort of household. But her little brother came home from school one day, started asking them about, I think her story is like, asking what KiwiSaver they're all in. And none of them kind of knew how to answer. And it turns out one teacher person had taken an interest in going, we need to uplift the knowledge in this primary school classroom so they've got equipment to deal with later in life. And it kind of shook her so much that was so immediate, and it became generational so quickly. And that kid had passed on some knowledge and interest to their family immediately, and it would have been happening with every kid in that classroom. That's got to be a really effective way to spread some level of interest in financial literacy and knowledge quickly, and that you get in with the youngest members of the whānau and spread it upwards, rather than try and teach adults who are already, spent 15, 20 years in the workforce. They're kind of living a day-to-day life, got a routine, how to suck it, trying to tell them how to suck eggs. Even if they don't know what they're doing, they're going to feel like they know what they're doing. And so there's going to be resistance. And it's the same reason why wellness packages and workforces always focus on like holistic health wellness rather than financial wellness, because the reality is the majority of employees in New Zealand would benefit from an upskill in understanding their finances, and then being able to have those conversations with their employer around things like, where does my salary sit in a band? How is my remuneration calculated? What's a total REM package versus my actual core money that's going to be received in the bank? But we don't do that because A, we don't want to talk about it, and B, it's quite hard once people are already, functioning adults. You're going to be better off getting them young. So I'm really proud of that again, and it's a topic. It's why I raised it, in fact, because that we're really passionate about is that trust comes from positive experiences. Finance companies of any sort, banks, insurers, lenders, never get positive coverage because it's always more attractive for the media, Fairgo, etc., to focus on the negative. It's the little guy versus the big bad, Australian corporation, whatever. That's a more sexy headline. And so you're not going to get that reinforcement of, we've paid we've paid in the billions of dollars of claims in our time as a business. You don't hear about all that. You hear about the guy who non-disclosed and then had his claim declined, right? And so it's frustrating, but you can't build trust in that environment because at the end of the day, whose voice is weighted more? Is it ours? Is it the industry's? Or is it Mike Hosking's or, New Zealand Herald's?
And I think you've raised a good point. It's so much easier, and advisors can have the most impact when they're dealing with people who have just a small foundation of financial literacy. So if we even ranked it out of, from 1 to 10,
yes,
advisors can take somebody from like a 2 out of 10 to a 6 out of 10 in an hour-long meeting.
Correct.
But if you just got somebody who's sitting at a 1 already, it's just you're kind of dragging them with you.
That's right. And it becomes so much inertia. You're taking your entire hour-long session to even get them to the point where they understand what you're trying to talk about. I mean, how can you accurately disclose things like commission rates if you're talking to someone that has such a low level of kind of financial understanding? It's actually rife with risk under the new regulation as well around proving customers' understanding throughout the journey. Now, I think that particular regulation's maybe a bit overcooked for what New Zealand needed, but it is what it is, and so it is what we have to consider.
And I think, I did an interview with an advisor who'd gone through an FMA monitoring visit, been randomly selected, and a lot of the time, the FMA auditors was, they're people who are IRD auditors.
Yes.
So their knowledge of financial products is limited.
Yes.
They'll admit that. I think what they're looking for is just that there's like a comparison, a bit of an understanding and explanation, so that if you can make it make sense to them, they'll likely be happy that the client made sense of it too.
I hope that's true moving forward. I know that there were plans to upweight resource in the FMA, and actually I quite like the FMA on a personal level. The interactions we've had with the FMA have been good. The regulations the only reason I say they're maybe a little overcooked is because there's quite a lot of overlap in the regulation that's been hitting our sector recently, particularly in light of the changes to advice legislation combined with the new COFI legislation, the Conduct of Financial Institutions, which is not FMA-led, it's Reserve Bank-led, but there's some really weird and grey areas in the overlap between there, particularly when you're a provider who works with an advisor force. 99% of our distribution is from independent advisors, and so the monitoring and oversight and demonstrability and liability that flows through the chain is really difficult to unpick at the moment, and it's really difficult to understand at what level of fidelity they're looking for, because the Reserve Bank is not like the FMA. The Reserve Bank are bankers usually, and so they also don't understand insurance. But the problem I have with my experience with bankers, having worked at insurance companies owned by banks and against insurance companies owned by banks as a competitor, is banks don't understand insurance. They really don't. And so, it's why they've all sold their life insurance companies, all of the banks in New Zealand, because, they realized after enough time, when it's no longer a boom market, I don't know how to make this profitable or successful when things are down. And that's really the definition of how good you are as a company, right? When times are good, it's easy to make money. It's, can you still make money and be viable when times are harder?
I was going to talk about, so a lot of the communication from the FMA, having been to a few conferences, generally they're saying don't overthink it.
They are.
So that's been the message that's been preached by them, which is different to a lot of other voices of the industry, which
100%, particularly if you listen to good reviews, comments, and that's not to denigrate everyone. Obviously, people are worried, and this is the biggest period of regulation change in this industry for quite some time. It is scary to think about, yourself being held to a different standard that's a little opaque, and I think that's the problem. It's not the wording of the legislation, it's not what the FMA is saying, it's the opacity, in that I don't have experience with an FMA audit. I don't have friends in the industry that have been through one and come out the other side to call on to kind of inform how concerned or not I should be about this. And so I'm really hopeful probably the next 2 years the industry will just calm down a bit about the regulatory changes, because they're here now. There's nothing we can do about it. Say what you like about the National Party talking about Kofi, they're not going to come in and repeal the advice legislation. There's no chance they're going to do that. And so we have to live with it. There's no point being scared about something we have to live with. If you're so worried about practices within your business that what are mostly quite easy to understand kind of legislative changes, then I would question whether kind of financial services and professional services is the right area. Because we are supposed to be professionals, right? This at times has been seen as a sales industry, but that's not what this is. We're supposed to be more akin to lawyers than we are to door-to-door salesmen of, vacuum cleaners. Exactly. It doesn't matter that in the past, maybe there's been some overlap in the people that have been attracted to those industries by the virtue of high commissions, but it is what it is. We certainly, from a provider's point of view, it's a very proud part of the providers I've worked for in the past that they're very professional. And the FMA RBNZ joint investigation into the conduct within the industry found no systemic issues and very few isolated issues as well in the life insurance sector. Now, general insurance, to my understanding, is a whole different ballgame, one that I'm not going to take part in, but we're really proud of our industry. Like, you look at the Trowbridge report in Australia and what happened over there, and it's a whole worlds away from what we've got here. We've got good providers. I'm representing one, which I'm very proud of, but by and large, all of the life insurance companies in New Zealand came out looking like they would be the gold standard in Australia, all of them individually. And so, that's something I think that should provide some comfort from all advisors who are in the sector in New Zealand, that, like the advice, there's maybe some opacity in the legislation surrounding how you get to the answer. But whatever the answer is, if you can justify it for that client, there's no unsafe hands here. No one's going to drop the ball too badly and, really butcher the experience for the client. Everyone's trying their best to do good things.
You've hit the nail on the head there. Using advisors as the vehicle to get Kiwis better insured and better, to improve their financial literacy, what can we do to get insurance products in front of more end clients?
Yeah, well, I think one of the challenges with the advisor network has been the remuneration structure of commission. Now, I'm not saying that in and of itself is a problem, but what has clearly been observed is advice processes take a long time to get to. They're quite involved and intense when it comes to life insurance advice for individuals and families, let alone, businesses or multi-party kind of situations. That's all well and good. Advisors know that when they go in, but what it does mean is there's kind of an unspoken rule around at what level of quote unquote net worth a client becomes worth getting out of bed for, in terms of the amount of the quantum of commission justifies the amount of work. And it's not really as low as I'd like it to be, in terms of there's quite a significant number of Kiwis who are de facto excluded from advice due to not having sufficient ability to pay premiums that would justify the commission off the back. I don't think commission structures as they are going to be changed or regulated anytime soon, or at least we're hoping, because I think commission is appropriate for the fact that advisors bear all of the upfront costs of client acquisition and they're not remunerated until, a policy is issued, which is quite a lag time from, down the funnel. And so commission makes sense to me, don't get me wrong, but it does create a challenge in that space. And I don't really know if there's one answer to that problem. So, as advice businesses get bigger and bigger and aggregate more, which is kind of what we're starting to see with the changes to more, I guess you'd call them corporatized advice businesses sort of coming through, and maybe it becoming a little bit less viable for the true one-man band type operators. If that continues to happen and we start to see something more akin to Australia with larger aggregated kind of corporate businesses selling advice, maybe spread commission becomes more viable. And so the quantum of commission is kind of less relevant because every commission is building an asset base, right? Maybe that becomes viable. The spread commission options in New Zealand are pretty good, but they're reliant on you not being a cash flow intensive business. So, being able to take the capital loss of all that time to get to policy issue to gain the much higher cash flow over time, over the life of that, expected life of that policy, that's maybe one solution. I think group insurance is a really interesting proposition in New Zealand. It's very, very low percentage of our market compared to almost any other Western life insurance market. So group insurance meaning it's purchased by an employer or association group, for example, a union, on their members or employees' behalf. And so generally the group itself is paying for the insurance, maybe with a salary deduction or maybe as a benefit as being a member or employee of that organisation. The challenge in New Zealand has always been brokers like Aon, Marsh, not Crombie Lockwood, who, nothing wrong with them, but they're multinational companies with expertise from like Australian markets with much bigger employers, much bigger associations. For example, the superannuation funds in Australia often buy insurance on all their members, which is hundreds of thousands of people in one go. You can get a lot better of a deal in terms of concessions on underwriting with a book that size, because your risk on any given person having, pre-existing conditions and whatnot is mitigated because there's enough spread. The challenge in New Zealand is there's only a handful of companies in general with enough employees or members that you'd even consider doing anything other than your normal underwriting process. A 20-person business has no leverage in terms of being able to obtain, but the brokers who deal in group have experience and policies that say, we need these things, right? And so it's been an undersurfaced market in New Zealand, truth be told. We are an SME nation. They always say that, right? And SMEs struggle with the ability to pay for such an offering, but there's other structures. But where I really think we're underserviced as an industry are things like unions, are things like big trade associations, because they have a lot more scope of mixed categories of workers. So, if I take a union for an example, some of the unions have a spread of everything from very blue-collar workers who are completely underserviced by our market up to, professionals and executives at some level who maybe are well-serviced, but you've got enough of a spread in your book that becomes a viable risk opportunity, and you're potentially getting insurance product in a way that's not costing a person anything on an individual level to a massive number of people who have been underserviced. Because I think once you've had one product, it's much easier to talk to you about product in general. The biggest barrier to buy is the first time buying anything, which is why actually I think medical insurance is maybe another option, is that, medical insurance in New Zealand is dominated by Southern Cross. There's nothing wrong with them, but they don't do anything else. And so they don't leverage that ability to get people on board for the first time through workplace schemes or, inquiry about health insurance because someone's grandfather got sick with cancer and needed chemo, whatever, into proper holistic conversations about all of the financial wellness. They don't really heavily utilize advisors. It's quite a direct sales process. And so that's cool. That's their business model. They're allowed to do that. Nothing wrong with it. But if you're able to get a piece of that pie and convert those customers who initially been interested in health insurance to conversations about more holistic risk while keeping it on the same policy, so you're not adding more complexity. It's just, more pieces to the puzzle. I think that's another potential way to get them there because, again, the numbers of people, there's a much higher penetration of health insurance than there is of any life insurance product in New Zealand. And lastly, I think financial literacy is just really important, right? Like I mentioned it before, but Australia, it's not uncommon to spend 7 or 8% of pre-tax household income on your insurances. If we had that kind of expectation in New Zealand, it's so much easier to talk to those potentially lower net worth or lower kind of income families and individuals because, the basic product pack you're sitting might sit at 4 or 5% of their pre-tax income. And at the moment, that's like, whoa, there's no way I'm not going to consider that. I'll spend $20 a month or whatever, and there's just nothing viable. Well, if there's a societal expectation that the adult thing to do is that you need to have insurance, which is how it is in a lot of the world, like that, South Africa, Southeast Asia.
Yeah, I was just thinking of that. I know a lot of advisors who have moved to New Zealand from South Africa, and they say it's completely different. People in South Africa expect to have insurance in place.
It's evidenced by the fact that, penetration amongst new migrants is massively higher than the general populace. And it's very regionally based. So South Africa is the classic example. Anyone with any sort of means in South Africa buys insurance. The penetration is extremely high. The same's true of quite a few Southeast Asian countries. So Vietnam's a very more recently a market where insurance has had high penetration, and so Vietnamese first-generation migrants are often seeking insurance. India is another good example. And so you get Japan as well, classic one. Japan's one of the most mature insurance markets in the world. And so migrants from these countries come and they immediately seek advice. And so they're not a problem. The stream of new migrants into the country are not the problem. The problem is, multi-generational New Zealand families. None of those generations is breaking the cycle of kind of low financial literacy and low financial complexity in terms of their kind of engagement with the industry. So we need to get in there somewhere because, if your parents have you on their health insurance policy when you're young and you have some interaction with financial product, you're already on a better starting position to talk, right? Advisors find it a lot easier when a kid who's been covered on medical insurance since they were age 12 becomes 21, they're commuting off onto their own cover. That's easy. Yeah, I'll do that for you. Great. I'll convert that. Don't worry. I'll sort it out. Hey, let's just have a quick conversation about you, right? And what you might need to know going forward. Easiest sell job of all time. You might not sell anything to a 21-year-old at that point, but you've planted those seeds. So now when they're 27, 28, they've got an income coming in, they've considering buying a house or having kids or whatever it happens to be, you got your foot in the door and that's an easy sell later down the track. And so, yeah, you just got to get the foot in the door, and it's Māori communities, it's Pacific Island communities, it's kind of lower socioeconomic areas that are super underserviced. So like Wellington, for example, is pretty well penetrated. Regionally, out in the countryside, you've got pockets of higher net worth sort of farmers and whatnot, pretty well penetrated, but there's a whole part, like large tracts of the country where there's no advisors operating and clients just don't engage.
Yeah, I did another podcast episode with Rochelle Carley from RMP Insurance. They're based down in Christchurch, and she's had amazing penetration when it comes to Māori and Pacifica communities because she hails from that background.
Yes.
And the trust they have with her is so much higher than just, let's face it, a white guy in a suit telling you need something.
Well, 100%. Particularly Māori community, it's a big one. Not that I'm going to say I can speak on behalf of by any stretch, but that authenticity within the community kind of standing or mana is so incredibly important. Like Pacifica is a little different. Pacifica is the community is a little bit more fractured. I'm again not speaking on behalf of, but I do have some Pacifica roots, so I'm not unfamiliar with elements of certainly my extended family. My grandmother hailed from Tonga. She didn't believe in insurance at all. In fact, when my mum started that, her daughter, it was like that you can't do that. That's evil. You're tempting fate. That's you can't do that. That's not something you can do. And so there is, it's not always that. That's being a little silly. That was my grandmother. She was unfortunately never really got educated on most things before coming to New Zealand. But there are these kind of cultural barriers all over that you can see that don't necessarily exist in some of those migrant communities from countries with more mature, I guess, financial profiling. I mean, the other thing is that, New Zealanders just don't like to talk to each other about serious things, right? We'll talk about the weather and the rugby, but when was the last time anyone listening to this kind of talked to their friend about how much you're earning? When was the last time you kind of asked for a salary increase? How's your Kiwi saver performing? Those sorts of things. Like, they're not hard to do. Maybe probably the audience of this podcast is more likely to have.
Probably outlier,
but you think about your families and your extended friends group, and are any of them having these conversations? Because normalizing those conversations are the only way to make it not feel icky or taboo.
Some friend groups that I've got, we talk about the kind of stuff all the time.
Yeah.
All the time. It's like the cornerstone of a lot of our conversations. Then I've got other schoolmates, and we would almost never talk about that.
Yeah. I think that's a very accurate point. Obviously, a lot of my friends group are people I've worked with over the years, so it's very heavily skewed that we like to talk about actuarial science and systems development and whatnot. But thinking about my wider family who are not involved, and the people I went to school with, some of whom are quite successful now in their own right, but none of them have those conversations. It's too taboo. It's too uncomfortable. But there's no reason it is. It's not inherently that. It's just, we as Kiwis, we're modest. We don't like talking about our success. We don't like talking about things. We're quite short term. We'll plan for this weekend, but we're not planning 2 years in advance or 10 years in advance. So, there's these cultural things as well that double it down as well.
I know that mortgage advisors are a great vehicle for getting insurance in front of people. It's often the best time because they're taking on a large amount of debt.
Yeah.
Now, Partners Life started a referral program through CAN where you can effectively refer a client. Why would advisors go for that option rather than maybe learning themselves or referring to another advisor?
Okay. Yeah. So we implemented this partnership with CAN because over a long time, from a career, not just from myself, but other senior members of our business, experienced people, we've seen it both work very well, where mortgage brokers become multifaceted and become insurance and mortgage brokers, form kind of family offices with both in there, or have referral partnerships with aligned insurance advisors. So, for example, under the same aggregator, mortgage advisor A works with insurance advisor B on like a referrals and commissions basis. We've seen it work really well. We've also seen it work very poorly. And there's a couple of interesting reasons why. So you mentioned mortgage brokers are the best time to get insurance in front of a client. It's the best time to introduce the concept of thinking about insurance in front of a client. But if you think about all of the paperwork that's going into your settlements, your legal documents, your signing off of the actual mortgage documents with the bank, whatever it happens to be, the stress that's coming with that, it's probably the biggest purchase of your life. You're on edge, trying to kind of keep it together. You don't want too many more things to think about. It could be sensory overload to introduce insurance at that point, like an actual conversation at that point. The best time to actually sell insurance is about 6 weeks after settlement, right? But to introduce the conversation before, so they're not off the hook, right? They've got something booked in there, they're in the pipeline. And so, it feels logical that doing both of them yourself would be the obvious thing, but too many mortgage advisors in the past have tried to do both at the same time and probably compromise both facets of their business because of that. I've got a good friend of mine who's a mortgage broker down Southways who I don't know if he will or won't listen to this, but he got out of insurance after being relatively successful to focus just on mortgages because he found it was compromising that too much. And that's not always the case. I'm not saying you can't do both, but it adds complexity and it adds kind of an element of you need to time those engagements well and really nail that transition between I'm a mortgage broker. I'm introducing insurance, but I'm still a mortgage broker. Now I'm an insurance broker because you can't be both at the same time. That's not going to work for the client. In terms of referring from mortgage brokers to insurance brokers, that works where there's mutual trust, where both parties know no one's going to try and steal the relationship with the client away, that both parties feel confident in the work that they're doing and the remuneration feels fair, which is difficult because often what we've seen in the past is I know mortgage trail amounts, sort of commissionable amounts, are a lot lower on an individual per case basis than insurance. Insurance is the headline, the big commission. And so the conflict in the past can often raise where, a mortgage broker sees the commissions that the insurance advisor is receiving, going, well, I introduced you to the client. I did half the work. Like, I want a good cut of that. But there's no cash flow in an insurance advisor business. There's no recurring kind of, big cash flow that's keeping the lights on. That initial commission is everything for that next period until the next sale comes through. And so that resentment can start to creep in, which can cause issues. It doesn't always, again, but I have seen that happen. Why we did this is just to provide an option, really. If you've got those things working successfully in your business, if you'd like to pursue those things, if you think you can do those things, you want to learn insurance and add it to your bow, you've got a friendly insurance advisor you're already working with, don't change anything. We're not proposing a replacement in any stretch. This is not why we're doing this. But we also know that there are a lot of mortgage brokers who are not engaged with any form of kind of conversations about other financial products downstream. And because the link is so clear between I've introduced new financial risk to a person's life, it is the best time to also get them access to a protection for that risk. We just wanted a different pathway that's a little easier and cleaner, because the other thing to note is you're providing advice on mortgages. It's being handed over to someone else to provide advice on insurance. Depending on how that conversation on the handover goes, what you say, how you say it, how it's documented, there is possibility of perceived liability of the advice that comes afterwards, because you've made a recommendation, you've kind of introduced, you've been in a financial advice process that at that point theoretically hasn't yet ended. It can be, I'm not saying it's quite risky, we don't know, is the problem. There's not enough precedent to know, what does that do from an advice liability point of view, so you have to be pretty comfortable. So what we've done with CAN is we have a team of internal advisors within Partners Life. We built them for our acquisition of the BNZ Life business. So this is not a new team of advisors we've hired to cannibalize, CAN referrals from, CAN mortgage brokers to insurance advisors. That's not what we're doing. We already had this team. We've got some capacity, and we've already seen well over 10,000 clients and provided advice to them within our world. But in a pure referral sense, which is for partners who don't want to have an existing relationship with an insurance broker. They don't have insurance knowledge or want to have insurance knowledge and advice capacity within their business. This is a clean handover. You send client details through, you paid a referral fee, and that's the end of that transaction. The client remains yours for all of the engagements you have with them on your book, and Partners Life will completely handle the conversations around insurance and anything that happens after that. So the advice side from insurance is pure handoff, and there's a one-off payment made. So that does mean, compared to what you might have seen before, the level of remuneration is slightly lower than what you'd see on a commission split, but that's because it's not contingent on success. It's a referral. Once the referral happens, whether we sell anything, we don't sell anything, the client says, well, actually, I'm going to go up the road to someone else, doesn't matter for the purposes of the mortgage broker, which just creates that separation from any conflict when it comes to the advice or the process that follows. I guess the other thing I'm really proud of in that space is we built a team of advisors, but we didn't want them to be like IFA type advisors. So they are limited to Partners Life product suite and selection. That's intentional. We're not trying to compete with the value that a IFA can provide to a client. We're trying to provide very good advice within a more limited scope to clients who otherwise wouldn't access advice or wouldn't have a channel to access advice. But, similar to Kiwi Advice Network, we've spent a lot on technology to enable that. So we've got some very, very cool tools, starting with, the portal to refer, i.e. the method by which you introduce the client and the journey that happens after that, to a system called Events, which we built, which is the only currently licensed robo-advice tool for life insurance in New Zealand, which is what's supporting our advice team. So the customer experience is pretty slick and pretty digitally enabled, pretty fast as well. But the scope of the offering is more limited than you could achieve if you had an existing referral relationship with a friendly insurance advisor, or you did it yourself. That's the trade-off. We're not trying to replace those, as I said. We're just trying to provide an alternate, easy option if you've got nothing in place at the moment to get your clients into a conversation around some protection.
And it's relatively new. What have you learned from it so far?
Yeah, well, we introduced a lot of new staff to this process because, I firmly believe for such a process like that, the delineation between financial advisor under law and nominated representative is an interesting one. We're a Class 3 FAP. That means that we can have nominated representatives. The only difference between the two is that we hold liability. Partners Life do. So that's important for two reasons. One is that if there's ever a client who has an issue, they're just taking it up with us. Our disputes resolution scheme, we're responsible for all the advice provided by our advisors. And obviously, as a large company, we've got good PI insurance. You're never having that situation where someone is, an advisor at a business, does some dodgy stuff, leaves, and then scoots the country, and there's no one from which you can, kind of abstract liability from. But the flip side of that is new starters coming in as nominated representatives. It takes them a lot longer than I thought not to get commuting with a client, i.e. having a good conversation, building rapport, but feeling comfortable pulling the trigger on recommending a sale, right? Like core sales skills. And so it's been interesting to me because my experience previously had been in advice businesses where you're generally hiring people from a sales background. So it's a lot more around, takes you forever to learn about the products and how they work and, how to articulate them in a way that a client would understand. We've had the opposite experience, which is, people understand that pretty quickly because most of them are from a customer service or claims type background. But that ability to just feel comfortable pulling the trigger, not the ability to pull the trigger and have a sales conversation, but feeling comfortable, pushing the go button with the client. It's real inertia. So, started off relatively slow early on, not slow in terms of number of clients through, but slow in terms of results of how many of them did we get, not through advice, but to purchase. And it's picking up quite a lot now, sort of a year in, once those staff are a little more comfortable. I think what it's also proven is that the model really works, but it works for those who it makes sense to work for. The bank's a classic example. The bank are never going to refer their clients. And yes, we did have this complaint when we announced this to the IFA market. Why don't you send those clients to us? Well, think about that for a second. You as an IFA, we don't know if you do KiwiSaver. The bank do KiwiSaver. They're not going to want you to cannibalize that client's KiwiSaver. You might do mortgages. Same deal. The bank want to keep mortgages. You might have a relationship with another bank as an advisor and, a relationship manager there, which could conflict. And, maybe you're talking to them about their core banking, right? A bank like NZ, Westpac, anyone else, they are never going to allow a referral to third-party advisors like that. They'll work with third-party advisors to, who bring clients to them, but not the other way around. And so that safety net of us being a big business, with no kind of conflict of interest in any other category has actually been a big boon, I think, to our success with the BNZ than potentially what had seen before with other insurance companies buying former bank insurers or working with former bank insurers, because that's a weird thing. Overseas, that bank insurance channel can represent massive, massive amounts of total market share. It's always been relatively small in New Zealand. I guess the banks have never quite figured out how to make that work. We're seeing some good success so far. So I think it's testament both to that kind of relationship building, but also I guess that the team we built, the structure we built, it works for what it is, which is if you've got a party that doesn't have expertise, doesn't want to have expertise, but has clients that need conversations that are only scoped to your life insurance needs and are really, really good, really efficient and provide a good solution, then it's 100% fantastic, But you have to acknowledge the fact that there are limitations to that as well. And so there are absolutely other options, which again, I'll just repeat it because I don't want this message to be missed. What we're doing with CAN is not intended to replace anything that's already working. Absolutely not. It's to provide options.
Fantastic. And if you are looking to pursue that, you can find it in the resources tab in Trail if you're a CAN member. If you're not, hit me up. Kris, thank you so much. I feel like you've shared so much of your journey and not just yourself, but also Partners Life. Some of your insights to the insurance industry and kind of peeling back the curtain have been really interesting for me. Thanks so much for joining us here today. Looking forward to seeing the full episode come out.
Great. Thanks for having me. It was really fun.